Hi, everyone. Anthony Caparino. Good to be here with you again. Today, I'm with my co-leader of the U.S. Transaction Advisory Group at A&M, Stacy Kirshner, and we're going to talk a little bit about M&A activity over the past year, 2024, some views on 2025, and then more specifically as well, various industries and what we are seeing in our day jobs and our experiences with deal activity. So with that, before we get into it, why don't I turn it over to Stacy to briefly introduce herself?
Thanks, Anthony. Stacy Kirshner. I'm a managing director with Alvarez & Marsал's transaction advisory practice and co-leader of our transaction advisory practice. I've spent 20 years in insurance M&A and 12 years at Alvarez & Marsal. Prior to that, I was with PwC.
All right. Well, Stacy, why don't we get into it? Maybe first topic here. Why don't we discuss drivers of FY24 activity, as well as some barriers that we saw with overall M&A activity in 2024? What were you seeing from your vantage point?
Yeah, I'd say there were a number of factors, but maybe to highlight a few. One, higher interest rates and the effects of 2022 inflation surge have certainly made deals more expensive. And with that, we continue to see a gap between buyer and seller expectations. Secondly, regulatory scrutiny. Deals are being scrutinized more closely by regulators. Following the Biden administration's executive orders on mergers, we have certainly seen a more rigorous review process and delays in getting deal done. Anthony, I think we, have historically seen deal processes close in 9 months. This year it was taking anywhere from 12 to 18 months to close a deal. And then lastly, I'd highlight longer exit horizons. Prior to 23, the average hold period was 3 to 5 years, and now it's over 7 years. And with the increase in continuation funds, that's certainly having an impact on hold periods.
Yeah, I think those were all relevant, certainly from our viewpoints within our practice. What ultimately happened because of many, if not all those factors you just described, is we saw longer processes. We saw a lot of processes that would stop for a certain period of time, start up again. And I think probably for the first time in our history, a little bit more of uncertainty when it came to timing of processes, whether it was on the sell side and when they would ultimately close, or on the buy side, how long it would take to get things done, and how long some of these auction processes realistically would take. I think everyone had good intentions that they would be quick on the front end, but I think in general we saw a lot of that being extended for all the reasons you said. How about some key drivers in 25 and what you expect to see going forward?
Yeah. So one, economic optimism, the push from private equity, and lastly, technology. So starting with the economy, the U.S. certainly seems to be landing in a soft spot. And this really started when we saw the Fed decrease interest rates in September of this year. So with lower borrowing costs, we started to see that price expectation between buyer and sellers narrow. And the lower rates will also boost confidence for equity heavy or minimal debt deals. And overall, from what we see from our vantage point, companies seem to have cash reserves. So we expect an increase in acquisitions. But primarily the push is coming from private equity. They're poised for an M&A surge, with more than $2 trillion in dry powder and LPs demanding returns. We expect, a heightened M&A market this year. There's significant pressure to sell portfolio companies and realize returns. And from what we understand, PE funds are nearing the end of their investment life cycles. And
Yeah.
then lastly, on technology, companies are increasingly turning to M&A for technology transformation versus, creating these technology enhancement in-house. So whether that's through AI, cloud computing, automation, or cybersecurity, that we expect to be a driving factor in M&A this year.
Yeah, I would agree. I think also there certainly seems to be, perhaps going into 25, a little bit better alignment between buyer and seller expectations. I think the period of time that had resulted in seller expectations really, really high coming out of COVID and the increased activity, I think over time those have come down a bit. I think that happened a little bit in 24. I think it's going to happen and continue to happen in 25. And what will help are all the reasons you said: pressure to invest, cheaper financing, slightly cheaper financing. So hopefully all those factors will add up to a fairly robust year in 2025, which obviously would be good for everyone. Why don't we turn it now to financial services, an area you're clearly experienced and spend a lot of time in. What do you see coming up for M&A activity in financial services, including insurance and financial technology?
Yeah, so maybe first breaking it down into the key sectors. We expect wealth management and insurance distribution to continue to drive M&A activity in financial services in 2025. These platforms continue to attract buyers for several reasons. The streamlined and scalable business model is attractive to investors. They generate cash flow and can grow and scale through M&A through, due to their fragmentation in their respective markets. Secondly, many founder-owned firms are motivated to sell as a succession strategy. Owners are looking to retire or otherwise exit. And then lastly, with the recent strength in the equity markets, clarity of the US political and potential deregulations, we're seeing a number of tailwinds headed into 2025. Diving a little bit more into detail on wealth management, the most recent peak of M&A for wealth management was from 2020 to 2022. And PE firms that back several platforms during those years are now looking for recap and exit opportunities that are on the horizon. So they're going to need to decide whether to merge with other large platforms to potentially trigger a domino effect in the space, go public, or perhaps raise money from public pensions and sovereign wealth. And we're certainly seeing some momentum from those type of transactions. Switching to insurance, insurance brokerage space continues to drive high valuations. So we're seeing a little bit of a pivot in the insurance space to managing general agents and assets in the TPA services space. We also expect to see heightened activity in the life and annuity businesses as individuals turn to annuities as a key component of wealth planning in response to the current interest rate environment.
Yeah, those are exactly what we're seeing right now in our practice. For those of you out there, we have a dedicated financial services vertical within our U.S. Transaction Advisory Group, and it's been a vertical for us that is high growth, a lot of activity, and it's grown every year since we've had it in existence. And right now, the end of 24, going into 25, there's definitely an uptick in activity that we're seeing across the board. So it's good to know we're certainly in the mix and commensurate it with market conditions, but we expect in 25 a lot of activity in that vertical for us.
So Anthony, maybe switching to tech and software, what factors do we expect to drive M&A activity and technology in 25? And how are companies adapting to stay competitive here?
Sure. I think much like a lot of the general factors behind M&A activity, there definitely is pressure to invest and um, pressure to provide liquidity to investors. So when you take a step back within software and technology, the high valuations in 20 and 21 created a lot of activity, frenzied activity, if you will, and people paid high multiples during that period of time. The public markets subsequent to that came down. Um, and now, again, going back to what I said before, I think there's more alignment in buyer and seller expectations that uh, I think will allow for continued activity within software and technology. Um, it took a couple years to come out of that rut, just given where the public comps were. But for our clients, both funds that are solely dedicated to software technology, as well as uh, more generalist funds that have a software and technology vertical, we're definitely seeing a lot of activity in the space across multiple technology type deals. So, um, people feel pretty confident that uh, things like AI and the emerging technology behind it will create more opportunities, particularly at a rapid pace as things change. So those are a few of the factors influencing investing within software and technology that we expect to see, and we're starting to see those.
Yeah, and we certainly saw the ramp up even heading into 25, right, Anthony, in the space. And also the variety of tech-enabled assets, healthcare, IT, financial services, fintech. So certainly, all those points that you highlight resonate. Expect to see a really active tech sector M&A activity going into next year.
Yeah, and as things change so fast, uh, you can only develop technology so fast. So the ability for private equity funds to go out there and get inorganic growth to keep up with the change, in some ways is a more economical route than developing further technologies within an existing portfolio company. So that certainly plays a part as well. And I would expect that as the pace of technology continues to change very rapidly, uh, private equity funds will continue to be out there looking for inorganic growth.
Makes sense. What are the key considerations for acquirers looking to pursue tech M&A in 2025, given the current markets?
Yeah, that's a great question. I think there's a ton of considerations, but I think probably the one that's most prevalent across most portfolio companies is really the ability to become more efficient. And technology really drives those efficiencies. We see it in our own business as we adopt new technology to help us with our financial due diligence, whether it's AI based or just emerging technologies that are out there that supplement the traditional use of things like Excel. But if you look at Tableau, Alteryx, things come out every day. So the ability to create efficiencies in one's processes, that's primarily the thing that is driving a lot of activity. And I think as again the pace of technology continues to change, the ability to create more efficient processes will help. Whether that's in government entities, um, the healthcare space, you name it. There's just a lot of processes that traditionally were manual and required a lot of headcount, and now those can be replaced with technology. So that would definitely spur a lot of growth, and I think we'll see continued focus because of that reason. I also think too, there's tremendous pressure, much like any industry, to grow the top line. Um, there are certain industries that have a heavy focus on R&D. So the ability to, again, create top line growth through more efficient uses of technology, as well as more efficient spend on the R&D side, supported by technology. Those are things too that drive a lot of investors to continue to be active in the space. And again, technology is somewhat industry agnostic because those same reasons would apply to financial technology, to healthcare, as I said before, governmental services. So there's a lot of uh, adoptability across industries for one particular technology. And so it almost has a compounding effect.
Yep. Let's move to healthcare. So how do we think healthcare M&A activity in 2025 will be influenced by operational efficiency, technology adoption, as you briefly mentioned, and the integration of AI?
Yeah, I think when you take a step back, healthcare has been a hotbed of activity for private equity for many, many years. Uh, Investments that roll up physician practices across different areas of healthcare, whether it's behavioral, pain, dental. Um, what happens is there's the need to, as you said, create efficiencies. So think of just simple things that we encounter in our daily lives: telehealth, um, the ability to consult with a doctor online without actually ever having to talk to anyone. That's all driven by technology. So there's definitely uh, a focus for many healthcare companies to become operationally more efficient. And there are ways to do that within a particular investment. There are ways to do that by acquiring technology and applying it to healthcare. So, the healthcare space, I think, will be a space that is going to undergo a lot of change for a number of reasons, some of which I just talked about. I also think too, there's definitely when you look at the other end of healthcare, so large hospital administrators, revenue cycle management companies, again, a lot of those processes can be improved and made more efficient through the use of technology and AI. And I think we'll see a lot of AI tools behind uh, healthcare processes that will create, I think, unique market advantages for some portfolio companies, and hence the interest in the space.
What about regulatory challenges and economic factors that could potentially shape healthcare M&A activity in 25?
Sure, you mentioned before, regulatory scrutiny that has created much longer processes. Healthcare is probably at the top of the list, particularly in the U.S. and the state of California. There's been a lot of scrutiny around, as mentioned before, the roll up of certain areas within healthcare. Um, there's the FTC and the scrutiny around monopolies in the industry. And maybe that changes with a new administration and there's less scrutiny, but those were certainly challenges that occurred in 24 and even going back probably to 23 in many cases. I think you'll see some of that in 25, but hopefully for those focused on healthcare at levels that are much less with a change in the administration. So I think that's the hope. Time will tell whether or not that actually transpires in a timely manner, but um, it certainly is a focus of many healthcare investors in the space. There's also within healthcare heavy focus on drug development in the life science space. That's an area with tons of scrutiny from the FDA and other authorities. So as that becomes more of a hotbed for investment activity, and I spoke about this with some of our life science professionals a while back here in this venue, um, there will be regulatory issues surrounding all of that. But again, I think optimism within healthcare is better from what I'm hearing from my clients that are focused on it, and I think expect, at least in the U.S., to have a better year in 25 than 24, particularly as the economy improves and some of these companies that have been out there for sale for quite a long time transact and exit the market.
Makes sense.
All right. Well, I'm going to turn it back to you now in an area that is not necessarily your area of expertise, but one that you and I both spend a lot of time in, given um, fact that we have a energy and infrastructure vertical. But why don't we talk about energy and infrastructure for a while?
Yes.
The renewable energy and the impact on the overall industry, I think, has been at the forefront for the last couple of years. So um, talk a little bit about the global shift towards renewable energy and how that's had an impact on investors in the space.
Yeah, so you're exactly right. And I think the renewable energy has certainly been the driver of M&A activity in this space up until the end of 2024 here. Going into 25 though, Anthony, with Trump and his administration, we do anticipate some changes and in almost every aspect of environmental policy that's going to impact renewable energy and how this will grow. M&A will grow in 2025. M&A activity in the energy sector for the last several years has been heavily driven by a shift toward renewable and clean energy. These M&A deals included technologies such as solar, wind, battery storage, hydro, and other clean energy technologies. And the focus on renewable assets was really driven by ESG focus from investors, more government regulation on emissions, and renewable assets becoming more economically viable because of lower material cost and tax credits and incentives to drive these incentives in the Inflation Reduction Act. So here we are now. We expect M&A activity in the energy sector in 25 to shift a bit from renewable and clean energy to more fossil fuel companies. The Trump administration is expected to focus on an energy dominance and reduce the Environment Protection Agency budget. And lastly, the expected relaxation of the FTC scrutiny and reduced EPA environmental regulations, there is a possibility of a significant M&A from oil and gas as well as the service sectors that surround it. And many of these mergers and acquisitions could produce a massive synergy for those combined companies.
How about global trade and the impact there? Given all of the dialogue around tariffs and not only tariffs, within between the U.S. and Asia or China specifically, but even within North America, between Canada and Latin America with Mexico. What are some thoughts there as far as the impact on activity due to potential tariff regulation?
Yeah, I think the primary point there is that it could affect some cross-border M&A activity. Sectors exposed to global supply chain or international trade may experience heightened uncertainty or even new opportunities, just all dependent on new trade policy adjustments.
Yeah, it's going to be a very interesting time for sure. I think talking about technology, financial services, and healthcare, probably a little bit more optimism. I think it sounds like, at least on the energy and infrastructure side, a little more uncertainty.
Yeah, absolutely.
All right. Well, those are some ideas around and discussion around specific industries. Maybe now you and I can just go back and forth. What do we expect in 25, just in general, and maybe more of our own personal points of view. So why don't you go first, and then I'll add my own after that.
Yeah, I think this was a healthy discussion, Anthony, to just kind of talk from a macro M&A opportunity going into 25 and then breaking it down by industry. But overall, I'm expecting an upward trajectory in M&A. The economy, is getting stronger and stronger to support M&A. You've got an abundance of PE capital, and then you've got the backbone of focus on technology through M&A.
Yeah, I would agree with you. I think also, if you take a step back over the last 2 or 3 years, as interest rates were increased to the level not seen in 40 years, a lot of private equity professionals had never seen something like that. So the ability to adapt to that type of environment and navigate a deal process was almost learned on the fly, in my opinion, across the industry for many. Now that it's been 2.5, 3 years since the shock of that happened, I think people are much more adept at navigating this type of environment. Granted, rates have come down a bit, but they're still historically pretty high, at least compared to the last 15, 20 years. But I think people feel better that they can navigate that type of environment. So hence more optimism. The pressure to put money to work, as we've said, is definitely real. The pressure to provide liquidity is definitely real. And so you put all that together, and what I think the general consensus is, and certainly, we see that in our business today, right now, is 2025 should be a better year than 24. Perhaps still consistent a little bit as far as timing with 24 regarding length of processes and the overall trajectory. It's probably less of a straight line and a little bit more of an up and down timeline for any process. But I would agree with you. I feel pretty good going into 25 that the industry is going to be more active. I think most industries should see an uptick in activity, and certainly that bodes well for our business. So I'm excited about it. And I think, sitting from where you and I sit, co-leading the practice, we have a lot of advantages to serve that type of market and that demand. And it should be a fun year.
Absolutely.
All right. Well, that wraps it up for today. Hopefully everyone learned a little bit as far as specifics around a few industries and just general views going into 2025. So with that, we'll wrap it up. Thank you. And we'll see everyone again soon. Take care.
Take care.